Good morning, everyone, and welcome to our DAT IQ Weekly Market Update. This is our last update for May of this year. It's May 28th, 2024. I'm Ken Adamo, Chief of Analytics over here at DAT, joined by Dean Croak, who's our Principal Industry Analyst, and very, very special guest, friend of the show. We have Adam Wingfield on with us this morning. Morning, gentlemen.
Good morning.
Morning.
I didn't log on early enough, Adam, to catch your College Football Alliance. That's kind of like the thing we do at the beginning of all of these shows. We've had quite the spectrum over the years of different college football or college sports alliances.
Yeah, I'm a big time Gamecock fan, man. I'm from Sumter, South Carolina, so you had only two options, just like in Alabama, you were either a Roll Tide or War Eagle. But in my neck of the woods, man, you can only either be a Gamecock or a Tiger. And in my area, it's Gamecock country.
I actually really like them as a program. I think they're really on the upswing. They have Beamer's son as their coach, right?
Yeah, and I think that the biggest change is when we had Spurrier and the years that we had, Gilmore's and the those guys that really changed the program around, man. Those were for some fun times, man. Fun times.
Yeah, like I said, I'd like to get down there and see a game. I'm generally a fan of the sport. It's just sometimes we have folks on. Dean will sneak them in with a Michigan background or an Alabama background, and I have to pretend for 45 minutes that I don't. But USC, it's my favorite USC. Put it to you that way.
If you've never been to a Williams-Brice football game at night, man, you're in for a treat. I'll just tell it to you like that.
We might have to make that hookup, and then you can come up to the Horseshoe for a Buckeye game.
I'm good with that. I'm totally good with that.
Nice. All right, we got a lot to cover. Hey, Adam, I know most people watching this are familiar with your background and what you're up to, but can you give a brief intro for those maybe less familiar before we dive into it?
Yeah, I've been in the industry almost a quarter of a century now, about 24 years. Started off as an independent driver, moved to owner-operator and fleet owner, and then worked into various supply chain management positions. And really, trucking is in my passion. I've been loving trucking since I've been about 11 years old and got behind the wheel of a truck for the first time as a country boy in South Carolina. And it's one of the things that it breeds in my blood. So now what we're focused on at Innovative Logistics Group is providing education, resources, and development for owner-operators and fleet owners so that they don't struggle with the things that I struggled with when I started off back in 2001 as an operator at that point. So our biggest focus is on education and resources.
Right.
Awesome. Well, thank you for joining us. We'll bring you back in a few minutes after we get through our market update for a great conversation, I'm sure. All right, let's get to our key points of the week so we can get Adam back on. Post road check week, seasonality returns. I think one of the cool things that you can suss out from road check week is more evidence that the market's close to an equilibrium. What you start to see there is when these events have a much more pronounced impact than the weeks leading up to it, is that the market doesn't have as much slack in the system, right? Imagine a rope that has a lot of slack and you pull on it being road check week. If the rope doesn't move all that much, it means you got too much slack. I think there's still some slack in the system for sure, but not nearly as much as we were maybe dealing with 6 to 10 months ago. But what you'll also see with that is once that pull goes away, the rates will start to come back down a bit until we see kind of a more long-term systemic shift back to the cycle. The Michigan State Truckload 10-mile index for March is down slightly. I'd argue that's pretty much close to flat. It's 1.1% year over year. Also, ATA tonnage index dipped about 1.5% year over year. So that the demand rebound's just not showing up in that data. Cash shipment index, all of these are basically trending in the same direction, which is good. You want your indices to trend. And then the National Oceanic and Atmospheric Association issued the highest ever May forecast for upcoming hurricane season. Never forget, tropical weather is a giant catalyst in a lot of cases for market cycle shifts. If we look back to the 2 cycles ago, it was Harvey and Irma back to back. Well, they weren't. I guess technically they were back to back. HI that really launched us into that ELD cycle. So it's just something to think about. We certainly hope for no loss of life or property, but those things do tend to happen and drive freight upward. So with that, I'll turn it over to Dean for our long-form market update.
Yeah, thanks, Ken. So following the capacity crunch that we saw during International Road Check Week, the market did settle down last week, down 2% week over week. Equipment posts were flat. Compared to last year, load post volumes are about 4% higher. Far fewer trucks, though, posting their equipment looking for loads. That's about 22% lower year over year. A load to truck ratio down slightly to 4.80. In the produce market, we're generating about 3% fewer truckloads last week, according to the USDA. That's translating to fewer overall spot market loads, down about 6% year over year. Reefer load posts surged about 33% during RoadCheck week. We heard about a lot of tight capacity coming off the West Coast in particular. Volumes were down last week. Equipment posts up slightly as a few carriers returned to the market. Net result was load to truck ratio down 12% to 6.88 loads per truck. And in flatbed, year-to-date load post volumes are on par with where we were in 2019 and also about the same as last year. But we're at this inflection point in the market each year where the market starts to cool if it's a soft freight market, and it's certainly shaping up that way right now when you look at the line charts. Load post volumes were down about 3% last week. Load to truck ratio down to 18.29. Having a look at a couple of our larger markets, some of our states in particular, following the capacity crunch from RoadCheck week, there was still some capacity tightness in key markets last week. Shippers moved about 5% more loads than the prior week ahead of Memorial Day long weekend. In the top 5 states in the dry van market, California, Texas, Illinois, New Jersey, and Georgia, volumes were up 6% last week. Line haul rates up 3 cents a mile to a 5-state average of $1.83. One of the larger markets in the Southeast, in Atlanta, carriers were paid an average of $1.96 for outbound loads. That was up 9 cents a mile week over week on a 6% higher volume of loads moved. The high volume lane south to Lakeland averaged $2.60. That was up 2 cents a mile on a 19% higher volume. So remember, these rates are line haul rates excluding fuel. Whipping over to the West Coast in Los Angeles, rates are up for the 4th week, averaging $1.82. Up 2 cents a mile on a 7% higher volume of loads moved. In the refrigerated market, as I mentioned earlier, there is a slight shortage of trucks in some markets. Volumes are down slightly, but when you get to a market level, you see a little bit different picture. Nogales has had tight capacity for quite a few weeks. The USDA is reporting a shortage of trucks on the Nogales to Chicago lane. Despite produce imports from Mexico via Nogales, Arizona, being about 12% lower than last year, truckload capacity for vegetables and watermelons has been tightening over the last month. Reefer rates out of that market are up about 7%. On the Nogales to Chicago lane, rates are averaging $2.30. They're up 41 cents a mile compared to the last year. That's certainly a good lane for some carriers running out of there, although it's not the biggest market for produce. That's you're going to see more volume come across through far in South Texas, Southern Texas. In the Pacific Northwest, capacity continues to loosen following what was a great season for produce growers up there and truckload carriers. Truckload produce volumes were about 17% higher than last week, but the market peaked in February and has been gradually sliding south ever since. Since the peak in February, volumes have dropped out of the Pacific Northwest by about 32%, rates down from a season high of $1.84 in February to $1.35 per mile last week. Surplus of trucks reported in the Yakima Valley and Wenatchee product districts also as that market starts to loosen from a capacity perspective. And in flatbed, capacity continues to tighten across the southeast region following last week's 6% increase in loads moved. The 11-state regional line haul average was $2.49 a mile last week. That's up 5 cents a mile week over week. In Savannah, line haul rates up 3 cents a mile to $2.59. Higher volume, about 20% more loads moved last week compared to the prior week. While in Atlanta, capacity was very tight for flatbed outbound. Rates are up 19 cents a mile to an average outbound rate of $2.66. Birmingham, Alabama, another big spot market for flatbed carriers. Loads moved up 7% week over week. Rates up 12 cents a mile to $2.66, with similar gains reported on the high volume lane south to Lakeland. And wrapping up our market update with our year-over-year look at spot rates, the national average dry van line haul rate was pretty much flat last week, remaining around $1.64 a mile. It's about 4 cents a mile lower than last year on a 21% higher volume of loads moved in week 21. On our top 50 lanes, based on the volume of loads moved, they averaged $1.97 a mile last week, up a penny per mile week over week, and about 33 cents a mile higher than the national average. Following the prior week's surge in line haul rates, the national average cooled last week, down just a penny per mile to $1.98, sitting about 7 cents a mile lower than this time last year. And lastly, in flatbed, following the prior week's 3 cent per mile increase during roadcheck week, line haul rates for flatbed were mostly flat last week, averaging about $2.07. As you can see on the chart there, that's about 12 cents a mile lower than last year on a much higher volume of loads moved. In fact, in week 21, we saw about 36% higher volume of loads moved last week compared to week 21 last year. So that's it for the market update. If you want to find out more about what's happening in freight this evening, the long form version of the report with charts and commentary will be posted to dat.com/market update. Back to you, Ken, for the short-term forecasts.
Thank you, Dean. So we're starting with Trivan as we always do. The blue line is the historical 7-day weighted moving average. We're going back to November here to give some historical context. And then we have 4 forecast models. We have red, which is short-term, green, which is ratecast. That's our flagship model. It's in all of our products. And then we have intermediate models, which are essentially blends of long and short-term forecasts that kind of straddle the fence of being responsive, but also showing some deference to history. You're seeing some model disagreement here. Honestly, I think this is a clear-cut case where the 2 intermediate models are in lockstep and probably a pretty darn good indication of where markets are going to head over the next 35 days. A little bit of plateauing. And then basically, if you look at long-term history, June is a pretty continual push as we make our way through the month to the 4th of July. And then things will start to fall off, which is something we should see appear in the ratecast models as we get closer and closer to the 4th. We have about 2 weeks until we start to see the 4th of July in our long-term forecast. Let's go to refrigerated. You're going to see a lot more model consensus here. Not a ton of movement up or down. You see that run up essentially culminating with roadcheck week last week. And then, like I said, models essentially just mixed about where they see the next 35 days. Ending with flatbed, which is more of the same, a ton of model disagreement. You're starting to see a little flare at the end where ratecast and some of the intermediate models are starting to show some strength, but the short term is noticeably flat as we head into the middle of June and the official start of summer. So let's bring Adam back and get to our question of the week.
Yeah, thanks, Ken. Adam, always great to have you on the show. Always look forward to learning some things that I don't know about trucking. With your vast experience and given all of sort of the flat market news that we're reporting, how are carriers getting by in this soft freight market?
You know, that's a great question, Dean. And the ones that are really fiduciary responsible and really understand the complexities within the industry, specifically the ones that understand the cycles. And we saw so many carriers, and you and I have had sidebar conversations about what the pandemic did for the industry in terms of just painting a picture that may not necessarily have been a true reality. It was more like a virtual world. But you have carriers that have experience in those market dynamics and those ups and downs. Right. What we saw is, and one of the things that I thought was so crazy is that I saw a bucket of carriers that were operating with operating ratios between 85, 86, 87, 88. And then I saw some carriers that were running with operating ratios at 105, 106, 107, 108, 109. So there were 2 totally different stories, but the reality behind it is when you see the ones that focus so much on the business side, we also saw the carriers that really had cultivated relationships a long time ago with brokers that they dealt with specifically. You know, the carriers that had 1 or 2 or 3 or 4 different brokers that they worked with versus spot carriers that were working with a ton of different brokers, whatever popped up, you know, they took. So I think that was a really, really interesting dynamic between the 2 schools of thought there is that, hey, you know what? Relationships really got a lot of carriers through the marketplaces when they were on the downside of it. They didn't overextend themselves. Right. So we did see a quite difference between the 2 schools of thought.
You know, what we were talking about this before we got on air. One of the phenomena we've seen is, and it's one of the more perplexing questions everyone's trying to answer, is how slow capacity is exiting the market, this market cycle. And we sort of hypothesized here at DAT it had a lot to do with how much profit carriers made. And to your point about the smart operators, we saw carriers, you know, banking money and getting ready for this next freight cycle. And I think the record profits that they made during the pandemic has given them a bit longer runway. So 2-part question, are you seeing the same thing where carriers have been able to pay down debt? And at what point do you think the money runs out? You know, like, because it can't go on forever, but We don't know when the market's going to turn this year, if at all.
So let me give you an example of that. So right before the pandemic, 2019, 2018, 2019, we were measuring break-even points. And at that point, break-even points sat anywhere between $1.65 to $1.85, $1.88. So think about that, $1.65, $1.88 as an operator. And if you're operating on a flatbed marketplace or you're operating on a drive-in marketplace, even in the lowest parts of the cycle currently right now, you still at least breaking even or making a little bit of profit on that, especially if you run shorter lanes and you're able to predicate that better. So the crazy thing is that the ones that really came into the marketplace at that point that had those lower costs, they're going to fare much, much better because of those specific things, such as ensuring that those break-even points were a lot lower. Mm-hmm. Now, as far as exiting a marketplace, a lot of them did that. I mean, they ran up some good capital. Some of them were able to pay down debt, where the other sides were buying boats and putting on more chrome on the trucks and buying brand new trailers because they were thinking that this was going to last forever. And you're going to have that. But there were some, and one of the things is I'll tell you is that this market ain't bad to everybody. You know, you think about it's the opportunity to scale equipment. We've got operators now that are scaling equipment because you can almost buy one, get one free at a used truck market. And I mean, I'm not going to say it's like that, but it's, you know, you buy a truck and you can get another truck at quite a discount. But you're seeing operators that took advantage of the highs, you know, stored away, and now are taking advantage of the lows as well in order to scale their companies and their operations. But as it scales out and as it flushes out and as we flush out capacity, the ones that were able to pay down the debt, the ones that were able to get ahead on the insurance, you can pay insurance, you know, you say, hey, I'm going to pay my policy flat out, right? I got a $22,000 policy. I'm going to pay this thing this right on out and I won't have to worry about it. Well, those folks are going to exit a lot slower because you're going to have those insurance cancellations and those revocations are going to take a lot longer for those to take place. So that there's some noise in some of that. You know, there's some noise in that because of that. So.
Yeah, we were at our broker symposium conference last week in Hilton Head, and we were talking about, you know, my view of the market was that I hadn't seen such a wide spread in operating costs in prior market cycles because of the amount of profit carriers made in 2021. So it's kind of created this bifurcated market where you've got a whole cohort that probably needs to run, you know, maybe 210 a mile as a break even, whereas there's a much bigger cohort, I think, this time around that behave a lot like Landstar BCOs, down at about $1.50 a mile. Because I peg our typical spot market carrier at about $1.82 a mile on 100,000 loaded, 15,000 empty. But if you were smart and got rid of your debt, so you could drop 31 cents a mile out of that, you're down at about $1.50, which is a bit below where spot rates are, excluding the fuel recapture. I think a lot of those carriers can get by, even still paying themselves a salary of about $60,000 a year. So I think that it's good to hear you sort of validate from your carrier's perspective what we're seeing in the market. I think that's sort of the unusual thing we've seen with carriers this market cycle. So just on that, you mentioned about carriers coming in. Our good friends at Act Research tell us that used truck prices are down about 20% year over year, but there is a flood of trucks coming into the both auction and used truck sales market right now as fleets look to more aggressively get ahead of 2027 with the new emission standards coming in. Are you seeing that as sort of a catalyst for carriers coming back in now that that average sort of 3 to 5 year old tractor price is dropping significantly?
Absolutely it is. And not just that, you couple that with some of the financing side of it getting much more aggressive on carriers to where they're providing down payment assistance because they see that these dealerships and these lots are just filling up with units and they're not able to move them with the same term. You remember when during the pandemic, man, you can go to a used truck lot and do donuts in a truck lot because there was no inventory there. Well, now it's totally different now because there's so much inventory. They want to move this inventory out there. They see that the market is soft, but they still got to entice the owner operator to say, you know what, it's going to be okay. Here, let me help you out a little bit. Right. So we're seeing that for sure. You know, but I think that what is crazy is the incentives that I'm starting to see, not just overall the inventory and the lowering of the pricing, but I'm also seeing some incentives as well. You know, like I said, I mean, I saw windshields where it's, you know, buy one, you know, get the second truck for this off. There was, hey, here's your down payment. We're going to double that for you. There's some incentives out there that they're trying to really kind of move some of this inventory out there. And that's enticing, right? That's enticing to the owner operator that might have a little bit of cash in his pocket. The company driver is saying, hey, you know what? I'm thinking I'm ready to make that move. So that's why you're seeing the, the N1, the out two type approach. And I believe that we're going to see that as long as you have those truck pricing the way that they are. And, quite frankly, you look at diesel fuel pricing, diesel fuel pricing is really pretty favorable too as well. So there's some wins in there that are inspiring some folks to say, you know what, might not be a bad idea. I hear everybody talking about the market's getting ready to turn. Maybe this is the opportunity for to buy low and get into the marketplace and ride the next 18 months, 19 months out on a cycle.
Yeah, that's a fascinating thought, because we've all been talking about capacity exiting, not so much about capacity coming back in, because the conditions are starting to become more favorable. Adam, can you talk a little bit about insurance? You mentioned 22,000 per power unit type insurance. I pay 10 grand a year with good insurance history. 22 more the norm for new entrants these days? And do you think that'll be a barrier to entry as insurance costs go up?
So that's a great question. So at 22 to 24,000, I've seen a range as far as for a new entrant with a fresh CDL. That's what we're seeing on that perspective. Obviously, you've got to include what that physical damage is going to do and how much it's going to change the policy, which is not much. But when you combine all three, auto, liability, cargo, and physical, we're starting to see about 20,000 as the average. Now, I've seen, prior to the pandemic, we're seeing anywhere between 16, 18, 19 across the board. Obviously, you've got some providers that are going to cost you a little bit more just because they're taking up on more risk. But another thing that's interesting is that we saw some of those insurance companies that were lowering the cost of entry. They're not only just exiting out of the marketplace, but they're putting new stipulations in place. They're saying, hey, we want to monitor your dash cams. Hey, we want to have hair follicle samples. So we're seeing insurance companies kind of change the landing strip a little bit from an insurance perspective, just to kind of lower their risk. Because if you remember going through the pandemic with the surge of carriers going into the market, insurance companies had surges of claims that were being paid out because it was just a flood of things happening. And some of them, quite frankly, some of their programs, quite frankly, didn't survive. So we are seeing a little bit of an increase when it comes down to those policies.
It's what we call in the insurance business a hard market. And a hard market is where underwriting capacity kind of exits. The thing that's changing, though, Adam, is the adverse development of longer-term claims, or longer tail claims as they cause them, because of higher medical costs. So it's not just the underwriting of a risk today as you present your slip to an underwriter. It's the claims that other carriers had 5 and 6 years ago that are developing. And when they talk about adverse development, they're getting more costly to process because of higher medical costs as we go on. So I think the takeaway from this is higher insurance costs are going to be here with us for, certainly all the rest of this year into next year. I don't see insurance costs coming down, which is a question we get asked a lot, because I don't think truck prices are a barrier to entry. I do think insurance costs are the biggest barrier to entry.
I definitely agree with that. And, you think about that too. A lot of the insurability there really relies on just the overall flood that, hey, when we go into an insurance policy with a particular client, sometimes if they got to front that on the finance side, on the front side, then that client's only in business for 3 or 4 months. Now all of a sudden that particular insurance carrier is out on the remainder of that policy. So there's a lot of risk, and they look at it as a risk as well. I'm going to try to mitigate that risk through increases on that policy. But I do see telematics. I do see safety systems being asked a lot. A lot of insurance companies are really kind of trying to field that out and kind of play that field. And I think that's going to be interesting as we roll downhill. Hey, is that something that we're going to see permanently, and will that change capacity for sure?
Yeah. It's I've spent probably a couple of decades before it came to the States working in insurance and insurance underwriting and loss control. And one of the things that I found that if carriers did this, they were most likely going to get a favorable outcome, both with claims management and underwriting, which was selling their safety program to the underwriter, not just the broker. And the carriers I would work with were ones that would come into our office with their broker and present their entire safety program. Because what you've got to be able to do is segment yourself out from all of the other flatbed carriers in the insurance company's portfolio, because you get lumped together, like all risks are kind of treated the same. But if you can find a way to market yourself a little bit better to your underwriter, good things are going to happen from that.
Hey, Adam, I want to I want to shift gears a minute. We were, like Dean said, we were with our broker customers last week, and there's a lot of healthy debate about the two big regulatory issues that are simmering. One being speed limiters, and one being kind of AB5 going national. Which of the two do you think would have a more pronounced impact on small carriers, positive or negative?
Speed limiters. I think speed limiters is one of those things, because you're going to have a lot more owner operator independents that are, operating on their own authority. So by they operating on their own authority, that AB5 would impact them as, the same way a speed limiter would be. And the thing about it is that truck drivers, quite frankly, are not paid by the hour. So because you're not paid by the hour and you're paid by the mile, then obviously not being able to turn as many miles in a specific set of time is going to have an impact. But when I look at speed limiters too, and Canada has been operating with speed limiter regulation for quite some time. So I understand that the family north of the border has been doing that for us for quite some time. But when I think about the interruptions in terms of, I hate to say it, just to call a spade, but the interruption in freedom and the interruption of the ability to be able to do so, you got the school of thought where, hey, you know what, it's going to cause more accidents, and you got the school of thought on the other side, it's going to cause less accidents. Kind of reminds me of, you got the mega carriers, obviously, that operate with speed limiters and have been doing it for quite some time. But then you got the second school where you got the carriers that have not been operating with those speed limiters. And I don't want to say that they're creating kind of a rogue approach when it comes down to not being able to kind of segment them the same way. I think speed limiters definitely is going to raise more red flags than anything else, first and foremost, especially with the independents.
That was my thinking. I think when you say, Dean, I was kind of in the minority with that thinking, though. I think there's a lot of folks that are very, very nervous on the brokerage level about AB5 and what the implications of that are. And I think it's more unknown, though, whether that's positive or negative, which is causing some of the concern. I think there's probably a case to be made that AB5 could be a wash with a lot of positive and negative outcomes, if that makes any sense.
And so that's a difference, and that's a big difference. So AB5, it could be a word here or a word there, or the way I say, hey, can do this versus the way I say can don't do this. It gives me a little bit of platitude. But when it comes down to speed limiters, when I got my foot all the way to the floor, I can't go no faster. There's no discussion about that. So it's a little different when it comes to the variables.
I agree. I mean, if you look at ELDs, right, if you say it took maybe 2 hours per cycle out of their drive time or their total on duty time, and it took the better part of probably 5 to 7 years to gain that efficiency back, I think speed limiters could be way more than 2 hours. It depends on where they set the number too, right? Like, I think 63 is catastrophic. 65 is probably really bad. 67, 68 is probably not going to be that huge of a problem, I would guess.
But see, here's the thing, and I mean, I'm going to talk out of both sides of my neck. I work for a mega carrier, and as a mega carrier, the one that I work for, we would govern at 62. We had 62 on the floor and 64 on cruise, and it was frustrating. But at the end of the day, we got to where we needed to go, and we handled business. But again, you're stripping away that owner operator from the freedom and the ability to run his business the way he chooses to run that business. But I do understand that. But, a lot of times we don't want more regulation when it comes down to a deregulated industry. We want less regulations to allow them to move as they choose. But that's going to be interesting. I'll say that'll be interesting.
Yeah.
I think before we wrap up, Ken, I think we'll start to see a similar phenomenon that we did in 2016. Because ahead of the hard ELD or the soft ELD mandate, carriers were leaving the industry. I was surveying them at the time, and carriers were leaving in significant numbers, enough to start to change the capacity level. So I think that could be something we might see from the guys that have said, now's the time to get out. All right.
Yeah, I mean, there's a lot, I think, regulatorily going on that's going to play a big part in the next few years. I mean, I think some of the broker transparency stuff, depending on how the FMCSA decides to take up and issue some final rulemaking on that, I think can have some impact. And I think there's different flavors of how AB5, I think, could be implemented nationally. So it's going to be real interesting to be on that end of it for the next probably 4 or 5 years.
Right.
The one thing I will say is that if the FMCSA makes rulemaking or guidelines, I think that's where it's going to be the really clear difference. Because, right, when they did the dispatcher thing, it was all guidelines and not rulemaking. And it's a big difference. So if the FMCSA and say, hey, here's my final guideline, then I think it's not going to make much of a difference.
Right.
That is very, very well said. I mean, I think a lot of folks were hoping the FMCSA went to rulemaking on dispatchers, and in fact, they didn't go that way. But we're running long, Dean. We're almost going to run long. You want to bring us home?
Yeah, sure. I'm on with Dan Deegan tomorrow on Logistics Live at 11 a.m. Eastern. Robert Rouse is on Landline now, as always, on Sirius XM Channel 146 Road Dog Radio. Chris Kaplis is talking to David Landau on this week's Freightvine podcast. And on next week, we've got Ibrahim Bayan from Nuveen talking about the logistics and warehouse market. Don't forget the Transportation Marketing and Sales Elevate event is on in New Orleans, June 10, celebrating their 100-year anniversary. I'll be speaking along with Lee Klaskow at that event coming up soon. So that's it, Ken. Back to you to wrap up the show.
Adam, how can folks get a hold of you if they want to consume your content or do a little business?
Follow me on Instagram at Adam L. Wingfield. You can find me on Twitter as well at Adam L. Wingfield. Feel free to tag me on LinkedIn at Adam L. Wingfield, and just reach out to us on our website at www.thetruckingconsultants.com.
Yeah.
Awesome. Thank you for joining us. I look forward to having you back on soon. It was a great conversation. We're going to sign off. The only plug I have is I'll be next week at FreightWaves. What's the name of that? This isn't a bit. I forget. It's the Future Supply Chain Festival down in Atlanta.
Right.
I'll be debating Zach Strickland about the future of the market. I think, unfortunately, as a spoiler alert, I think we're probably going to have more in common in terms of our outlook than. I think there'll probably be some more disagreement in the rear view as opposed to the forward view, as we currently sit. But Zach's a really nice guy from everything I've heard, so it should be fun. It should be. Lack of fireworks is I think what we're all hoping for, but it's always fun to get down to Atlanta. It's a great town and see some folks in the industry. So I probably won't be here next week now that I think about that, but anyway, have a great week. I'm sure you'll at least see Dean and Ibrahim next week, and I'll probably catch you in 2 weeks. Bye everyone.